Have you heard of the company Deloitte, or maybe PricewaterhouseCoopers, or KPMG, or Ernst & Young? Of course you have. These are the big four accounting companies, right? Who hasn't heard of them? But do you know that earlier they used to be big five? There was a fifth company named Arthur Andersen, and their name right now has been erased due to time. And of course, this erasure from history happened because of some extremely shady practices, and Arthur Andersen was one of the reasons that gave us the biggest accounting fraud in the entire world. In this video, you'll learn how accounting fraud works. The reason being, to catch a criminal, you need to first start to think like one. And my name is Aditya Iyengar CFA, and it is my responsibility today to teach you about this accounting fraud. So let's get into it. There used to be a company called Enron. This was once the 7th largest company in all of America. This company at its all-time high had their shares priced at $90.75. Do you know from this point what happened? The stock price fell by 99.99% to just 50 cents a piece. Common people, retail investors lost a lot of money. People lost their jobs. How did the company get here? Now you already know that every time a company is publicly listed, that company has an obligation to its shareholders. The company reports their earnings every single quarter, and at the end of the year, they tell their shareholders that look, over this last year, we earned this much money, these were our assets and these were our liabilities. Once the company reports these figures, there's an external auditor that has to come and verify the company's claims. This auditor has to make sure that all of the company's financials have been prepared fairly. Now, Enron's external auditor was one of the big five firms, Arthur Andersen, and this was a company that is cited as one of the largest audit failures in the entire world. Now, to understand this accounting fraud better, you need to first understand the motivations behind financial reporting. If analysts expect a company to grow by 10% this year and the company actually ends up reporting a number of 12%, then the company's senior management makes a lot of money. The more the company does this, the more consistent they are at it, the more money management makes in the form of stock options or directly stocks. Now, because of these incentives, a company can actually report whatever they like, right? They could directly lie to you to just make some more money. But this is why we have auditors. And this is what Arthur Andersen was expected to actually catch. But did they do that? Let's find out. So back in 1985, there were two companies, Houston Natural Gas and Internorth Incorporated. These two companies merged and they created a company called Enron. Enron was basically an energy company that was led by a guy named Kenneth Lay. Kenneth Lay was actually one of the longest serving employees of this company, and after he became CEO, there were a lot of things happened, and this is when people discovered the first ever red flag about Enron. Now, Enron was a traditional energy company, but they also had a lot of trading operations. Kenneth Lay spotted two traders actually manipulating these trades. What they were doing was borderline illegal. They went above and beyond and took more risk with the company's money than they were permitted to. Basically, they were gambling with the company's money. Now, do you know what Ken Lay did when he found out about these two traders? He actually just indirectly told them that, see, what you did wasn't exactly legal, but it's actually encouraged as long as it's making the company money. Basically, he overlooked the entire thing and encouraged this sort of behavior because his earnings were going up. And when I say his earnings were going up, I mean that two ways. Number one, the company's earnings were going up, and because of that, Ken Lay's compensation as the CEO was also going up. As the CEO, Ken Lay did a lot of other things that would now be frowned upon. On behalf of Enron, he made large donations to George Bush's campaign. In fact, even before George W. Bush became president, he let his father, George H.W. Bush, ride in his private jet. It is obvious that all of these favors were actually calculated and in return for something. What is that something? An extremely shady, confusing, and manipulative accounting technique. You'll see it now. As the CEO, Ken Lay was making a lot of money, but he wasn't satisfied. He wanted to make more of it. At the time, McKinsey was a company that was consulting Enron. One of McKinsey's employees, Jeffrey Skilling, was actually a great talent and a fantastic leader. Ken Lay spotted this and decided to hire him. Jeffrey Skilling was made CEO of the Enron Finance Corporation, and eventually he was also made CEO of Enron.
We're trying to change the world.
Once skilling was a part of Enron, he pushed for something called mark-to-market accounting. He wanted Enron to use it in its accounting practices. Now you are very likely to close this video if I start explaining what mark-to-market accounting is. So let's just understand it with the help of an example. Let's say Enron is building a factory. Now this factory would have certain operations and this factory would bring in some sort of revenue for Enron. Naturally, before building this factory, Enron would try and project what kind of revenue this factory would bring in for them. Let's say Enron believes that in the first year, the factory would make them $100 million. In the second year, probably 110 and so on. Now, this is the shady part that Enron did. They calculated 10 or 20 years of revenue that the factory would make them in the future today and added it to their revenue. Revenue that has not even been earned. This is all just expected revenue that might have come in the future. This is called mark-to-market accounting. Now, before you think this is stupid, mark-to-market accounting actually has some uses. In fact, it has another word. It's called fair value accounting. Let's say Enron was to sell this factory to someone. This is exactly how they would calculate the value of that factory. That is by projecting all the future cash flows of that factory and figuring out what would these cash flows be worth today. I'll give you another much simpler example. Let's say Enron signs a contract that earns it $10 million every single year for the next 10 years. So now legally, Enron could not recognize all of that future 10 years revenue today. But that's exactly what it did. $10 million for the next 10 years, that is $100 million is what Enron recognized as their revenue on this day. Now, there is a possibility that the other party cancels this contract the next year, but that possibility was entirely ignored and Enron recognized $100 million of revenue on this day. This is what you call mark-to-market accounting or fair value accounting. Now, this makes a lot of sense for financial companies because they mainly invest in stocks and bonds, and it makes sense to report your stocks and bonds at their fair market value. But if a company tries to do this with all their assets like their factory, their machinery, their projects, their contracts, then it becomes extremely difficult to reasonably determine the value of all of these assets. This is where accounting judgment comes in and companies kind of try to get sketchy, which is exactly what Enron did. They got creative with their books and started recognizing every single thing possible as revenue. In accounting, this practice is called accelerated revenue recognition, and in most countries it's illegal. But if this is illegal, why was Enron even allowed to do it? Well, that's the thing. Enron was an energy company that eventually moved into trading and also tried its hand at broadband.
We are proposing the development of a broadband operating system.
And in the 1992, the SEC, that is the US's stock market regulator, they approved mark-to-market accounting even for non-financial firms like Enron. You remember those favors we just talked about? This is what Enron got for them. Eventually, Jeffrey Skilling became CEO of Enron. And as CEO of Enron, he was one of the most ruthless leaders in the company. Skilling expected only the best from his employees. In fact, he graded all his employees from 1 to 5, 1 being the best and 5 being the absolute worst. Now, in his company, 10% of all employees mandatorily had to be graded 5. And unfortunately, if you were one of those employees who were graded 5, do you know what happened with you? At the end of the quarter, you would be fired. So this ruthless competition pushed Enron employees to work up to 18 hours every single day. The employees tirelessly worked and came up with innovative new ways to inflate the company's profits. Let me give you an example of what happened in the year 2000. This is the time when we didn't really have Netflix. So there was a company called Blockbuster and they partnered with Enron. They signed a contract. And if you haven't understood this by now, every time Enron signs a contract, which is simply a piece of paper, they recognize billions of dollars as revenue. As soon as this contract was signed, Enron recognized millions of dollars on their income statement as revenue on the day it was signed.
This is a demonstration of the graphic user interface for the Blockbuster Enron video on demand service.
So this partnership was basically a video on demand service where Blockbuster provided the entertainment and Enron provided the broadband to watch this entertainment. And do you know the funny part? This partnership didn't even work out. This deal fell off because Enron's broadband was extremely primitive. But in spite of this, Enron recognized $53 million in profits. $53 million of money that wasn't even earned and probably was never going to be. Enron also has a sad connect with our country. Enron had invested billions of dollars in a plant in India in order to sell electricity. As soon as they invested in this plant, they recognized billions of dollars of expected future profits. Profits that haven't even been earned. Now, once the plant was completed, Enron was unable to sell any energy in India because the Indians at the time were too poor to afford this. But in spite of this, Enron's financials looked flawless thanks to mark-to-market accounting. You know, the stock market is a funny place. There were a lot of people, asset managers and analysts who were seeing these red flags, and yet they continued buying Enron stock. Why? FOMO. Enron was a company who consistently reported great results and the stock price kept rallying. Now there were some cracks that had started to appear. One of US's top financial journalists, Bethany McLean, decided to investigate this. She sat down with Enron's CEO and asked him, how exactly does Enron make money? And do you know what he said? I don't think I should be answering this question because I am not an accountant. You should rather talk to Mr. Andy Fastow, who's our CFO. Which is exactly what Miss Bethany did. And do you know what Andy Fastow said?
Andy Fastow turned around and looked at my editor and me and said, I don't care what you write about the company, just don't make me look bad.
And he let Bethany write the article the way she wanted. Andy Fastow was the one who pioneered the use of special purpose entities in order to wipe out Enron's debt. Artificially, of course. What this means is Andy would create another company, effectively a shell company on paper, and transfer all of Enron's junk assets to this company. What that would do is make these assets go off balance sheet and make Enron's balance sheet look greener. And the worst part is that Enron wasn't alone. They had accomplices. Huge US banks such as Chase, JP Morgan, Merrill Lynch helped Enron do their dirty business. Right before Enron had to report results to their shareholders, all of these large banks would go and buy all of Enron's junk assets from them. And as soon as the results were reported, these banks would sell these assets back to Enron. So basically, on the day of results, Enron's balance sheet looks great. Now obviously, Enron couldn't do this forever and they needed new deals and new contracts, new projects to make more money. This is when Enron moved to the state of California and figured out a new opportunity. They started an energy supply business in California, and in this state, after their operations began, their energy supply doubled. But in spite of that, California was facing continuous blackouts. Why is that? Because Enron's traders figured out another immoral way to make money here, they started manipulating the energy market. During periods of low demand, they would move the energy out of state to other grids, and as soon as the demand rose, they would move it back into the state to be sold at a higher price. Since electricity pricing in California was dynamic, this helped Enron make millions in profit. I mean, just imagine this. Your locality's energy supply doubles, but in spite of that, you have to face 6 hours of blackouts. That's exactly what was happening in the golden state of California. Eventually, people started realizing things. In 2001, Bethany McLean wrote an article in the Wall Street Journal, after which Skilling resigned. This event happened in the most unexpected fashion, and Skilling even said that when I left the company, it was in great financial condition.
On the day I left, on August 14th, 2001, I believe the company was in strong financial condition.
Now you might be wondering, we started the video talking about Arthur Andersen. Where were they when all of this unfolded? It's very simple. Arthur Andersen were continuously being pressured by Enron to issue unqualified opinions. When Enron collapsed, Arthur Andersen shredded 1 ton of documents belonging to Enron that showed all of this crime. Obviously, they didn't get away with this. They were convicted of obstruction of justice. After this, all of their clients fired them, and eventually the company had to shut down. Enron's activities and Arthur Andersen's failure as an auditor led to the Sarbanes-Oxley Act being introduced in the United States. This was a piece of legislation that made accounting-related laws a lot more strict. Fines and penalties were made a lot harsher, and now auditors were not only required to comment on the financial reports of a company but also their internal controls. The auditor also had to issue an opinion on whether or not the company's governance is sound. A lot of accounting rules and policies were changed, especially the rules surrounding mark-to-market accounting. The government made sure that this policy can no longer be misused. And you might be wondering, what happened to the employees of Enron? They all lost their jobs. About 20,000 people from this company lost their livelihood, but the executives made $774 million in just the preceding year. Kenneth Lay didn't face any jail time because the stress gave him a heart attack and he passed away. On the other hand, Jeffrey Skilling was sentenced to 24 years in prison. Although he was released in just 12, and as soon as he came out, he even tried starting another energy company. If you found this video valuable, subscribe to Personal Finance TV for more such content. It's free.